Good morning, Juan. I'm very pleased and honored to share this panel with you today. Having spent all my career in finance and risk management, I have had never the chance to work or share thoughts with natural scientists, as I guess most of our audience today. So let's discover together what happens when finance meets natural sciences.
Yes, no, it's great to be here from the science in a Risk Minds conference. I'm part of an organization called CGIAR. It's kind of huge. Actually, it's the largest international research organization providing public goods on food, land, and water systems transformation. We have more than 8,000 scientists that work in more than 110 countries. We have $1 billion of execution every year. We are funded by large ODA donors as well as Bill and Melinda Gates and other organizations. So how to bring all that knowledge that has been there for the last 40, 50 years, but now working in a more integrated fashion into this conversation, how to relate what is happening in terms of our change, which is opening a lot of ground for us. We, for example, this year in Italy, we went to Florence, where you live, to the G20 Ministers of Agriculture meeting, and CGIAR now takes the floor in G20 meetings, in the Ministers of Foreign Relations, for example. So we're part of the development conversations, significant players in the UN Food Systems Summit. So this wealth of science that has been kept more into agricultural discussions, I think there's a huge opportunity to bring it into the discussions about risk, about finance, about business in general. So it's great to be here.
Yeah, and it's very impressive, and those are great assets for financial institutions.
That we need to leverage better.
Yeah, better, and let's try to see how we can establish such a bridge between an organization like yours and the financial industry. So let me start maybe for the audience that we are having today about a short introduction of what biodiversity means and why it's such a source of concern. So we have to realize that biodiversity is the living fabric of our planet. It covers not only all ecosystems, life forms such as plants, animals, fungi, bacteria, but also the interaction that exists between the multiple organisms that populate the biosphere and between these organisms and their living environments. It may seem very complex, but we cannot ignore it, or even worse, take it as granted anymore. Biodiversity creates flows of ecosystem services which benefit and create value for business and society. This is called the natural capital. The OECD estimates that ecosystem services provide societal benefits worth between $125 and $140 trillion per year. And guess what? For free. But biodiversity is at risk. The 2020 Global Risk Report of the World Economic Forum concluded that biodiversity loss is among the top 3 global risks based on combined likelihood and severity. Yet, unfortunately, the same report still does not identify it as an imminent risk. The biggest focus is still on climate, while biodiversity, which directly affects the future of humanity, is merely mentioned in ESG reporting. This is both surprising and worrying, as we are fast approaching a global biodiversity threshold, which, if crossed, can lead to a significant and possibly irreversible decrease in natural capital. To put things into perspective, while the long-run damages of emissions are estimated at around $1.7 trillion per year, those resulting from biodiversity loss range from $2 to $4.5 trillion per year. That's food for thought, isn't it? So, Juan, why is nature and biodiversity so vital for our economies?
Well, Dominique, people tend to take food for granted. We sometimes worry because the rhinoceros is threatened and there is a beautiful story in National Geographic, but we don't realize sometimes that our food doesn't come from the supermarket, but it depends on fresh water availability, on healthy soils, on what you mentioned before, these beneficial microorganisms that really are the only way that things can be brought together under something that we call an ecosystem, which is basically the interaction of these living elements together with physical and chemical ones. This ecosystem is the house of where biodiversity lives. And biodiversity is very critical in terms of providing a wealth of essential goods and services for society. The oxygen we breathe depends 98% of plants available, for example, and this interdependence is very critical when we look into food and agriculture. Our capacity to produce depends solely on biodiversity, on in particular and something, a subset we call agrobiodiversity, which are those plants, animals, microorganisms that interact to be able to feed people, and that are the result of thousands of years of interactions between humans and nature. So biodiversity, unfortunately, is declining because of climate change, but also very strong environmental degradation. We're losing forests at a huge speed. The natural environments are shrinking. Fresh water withdrawal is excessive at the moment. It's surpassing the replenishment of those water sources. So we are using in excess our natural capital and still see more than 800 million people going to bed hungry. So there is a very big problem that requires us to rethink how we transform and redefine our food system. So you mentioned the sixth mass extinction. That means there have been other 5, so maybe we should not worry, but this one is very different because the previous ones were related to glacier cycles, but this one is of an anthropogenic origin, and it's going very, very rapidly. In the past 100 years, the action of humans in our planet is driving this extinction, this 6 mass extinction, in an almost unmanageable trend. So we really need to work on this, and of course in our domain of expertise we focus a lot on food, and for that let me give you a few examples of what's happening in agrobiodiversity. So the thousands of plants humans relied upon to feed themselves, and actually they had quite a good nutrition. Now we rely on less than 200, and of those 200, only 9 species, plants and animals, account for 70% of total crop production. So we are in this funnel, an homogenization of the food system that's starting to exacerbate risks in a significant way. People know already, or maybe for those of you who don't know, rice, wheat and maize alone are providing more than 50% of the calories humans eat. And in only 48 years, in the last 50 years, the diets worldwide have become very, very homogeneous. So it's not only homogeneity at the landscape, but also a more and more boring and average plate of food that even doesn't account for traditions and a lot of other elements that are being lost. So there is an issue where we are not consuming enough nutrient-rich foods, and where the lack of that biodiversity at the landscape is, as I said, exacerbating risks. So this is not only a conservation and nutrition issue, but it basically undermines the resilience and viability of our food systems and how they withstand pests, diseases, and climate change. So we must transform food systems. That was the mantra of this year's United Nations Food System Summit. So we make sure we benefit people, nature, and climate, manage to keep our economies thriving and leverage gains achieved in agriculture productivities over the past centuries. So while climate has been kind of in the radar in these discussions for a long time, because carbon is a more straightforward variable to understand, we need to understand that biodiversity is as or even more significant and has received less attention. So this is a lag that we need to address urgently. So how do you think, Dominique, financial institutions should be paying more attention to nature laws, and they don't have to worry because they may not be impacted at all?
Yeah. So indeed, financial institutions should worry. That's true that, as you just pointed out in details, that natural capital is being damaged and put at risk, and it would be completely unrealistic to think that financial institutions won't be affected by it. And to speak a language that the financial institutions would understand, let's talk about indeed the financial risk that might arise from decline in nature. So basically, the fact that nature capacity could be reduced to provide ecosystem services, either temporarily and, by the way, even permanently, might have a direct effect on companies themselves. These companies are recipients for finance and investment. They are sources of tax revenues and key links in supply chains. So if those companies become vulnerable to an ecosystem service decline called physical shock, then that will translate into a vulnerability for investors, lenders, insurers, governments, connected companies, and by extension, they would be a major source of financial risk. So to give you a few examples of financial risk that might be encountered by banks and insurance companies, we're talking about credit risk. Credit risk would arise from, for instance, production disruptions that might lead to increased defaults of counterparties. Market risk would result in case of repricing of stranded assets that would lead to reduced market value of investment portfolios. Underwriting risk would arise from increased insured losses due to more claims. And liquidity risk will be prompted by increased demand for liquidity. We shouldn't forget the non-financial risks, such as operational, business, and franchise risk. And franchise risks are severely impacted by reputational damages that can happen due to, for instance, new customers' ESG preferences or clients' controversial activities. And we have to be also very realistic that this non-financial risk, as they will impact, for instance, the ESG ratings, will also turn to be financial losses in a day or another. Parallel to physical shocks, there are what we call transition shocks inherent to regulatory or market effort to address environmental harm. And they can negatively impact companies, and if they negatively impact companies, financial institutions will also be impacted. It's also important to raise here the so-called double materiality principle, because it's not only the environmental impacts that are material to companies and financial institutions, but also financial institutions and companies' capital allocation decisions that are material to the natural environment. So it goes both ways. So to conclude, I would like us to remember that all businesses depend on natural systems, either directly or through their supply chains. And let's be very clear on this, without the natural capital, there won't be any possible sound businesses. So for those who might not be convinced yet, let me give you a few more figures to illustrate this statement. $44 trillion of economic value generation, more than half of the world total GDP, is moderately or highly dependent on nature and its services. Interestingly, the DNB assessed last year that 510 billion euros of its investments made by the Dutch financial institutions is also highly or very highly dependent on natural capital. This represents 36% of the entire Dutch investment portfolio. In France, the percentage is even higher. Last August, the Banque de France reported that 42% of the value of securities held by French financial institutions comes from issuers that are highly or very highly dependent on one or more ecosystem services. The least we can say is that those investments are sitting on a time bomb, referred as a silent spring by Banque de France itself.
I agree with you a lot. These risks, raising risks, are clearly being transferred and becoming financial risks. And let me give you 3 examples of underlying problems that end up hitting the economy and business. One is what we refer to as soil health. As soil erodes because of mismanagement, it generates a higher likelihood of not meeting its function, its productive function, and therefore promoting failures for the crop, or much higher costs than usual. So soil carbon, soil biodiversity is something that we need to be watching, and there is very easy ways and sensors in order to do that. So that's something that we could incorporate quite easily into this. The second thing is that we are seeing a number, and we saw this in COVID times, supply chains relying on one staple, one commodity that, of course, you get economies of scale by specialization, but we become so excessive in the specialization that the risks are becoming unbearable, and we're seeing more and more failures in those value chains that are just too focused on one species. And then, of course, we need also to understand what's happening with a more conscious consumer, that especially in what relates to health, and how we can relate a healthier diet with the need of a wider diversity of crops, of animals at the farmer's field. And as this trend happens, we will again see a mismatch between those homogeneous, highly efficient supply chains with what the market will demand. So, Dominique, what would be the implications of business if they were to embed natural capital into their decision making?
Yeah, that's true that financial institutions will need to embed natural capital into their risk management frameworks to start with. Though this will encompass a set of actions for the chief risk officers who sit in this audience. They will need to assess first the dependencies of their risk matrix, like capital at risk, liquidity at risk, earning at risk, and franchise at risk, on natural capital features. To do so, they will have to run what we call natural capital tailored stress test scenarios to their portfolios, and then they will have a better understanding of what those key sensitivities look like. Their risk appetite will have to be redefined, starting with qualitative statements and evolving towards more quantitative modeling when data become sufficient and reliable. And as a very first step, as highlighted by some supervisors, financial institutions are expected to identify within their loans or investments or underwriting portfolios environmental controversies. And it's very important that they start to act upon these environmental controversies. Let me emphasize something which is very interesting, that some financial institutions are already using tools referred as integrated biodiversity assessment tool to run their clients. So they rank their clients according to that tool and take actions based upon that ranking. For management and mitigation purpose, it is important for financial institutions to distinguish among risks that create business and societal value, like access to more competitive funding, better rating, positive impact on reputation, opportunity for new sustainability-linked products and services, from extreme risk that need to be managed for resilient purpose as they pose severe business threats. And what we see today is that more focus is being given on extreme risk, while there are all the other type of risks which are very interesting as they are creating values. Proper mitigation strategies will have to be defined as well to remain within pre-agreed risk appetite sphere while ensuring resilience and proper governance. And importantly as well, mitigating natural capital related risk will imply sound investments in the green economy for short and medium-term impacts on both liabilities and asset sides. It is of paramount importance for financial institutions to make decisions based upon a holistic view of risk and opportunities related to natural capital. They should consider the cascade of risk through the entire value chain, as we discussed earlier on. Only then they will manage efficiently their capital, liquidity, earnings, and franchise in a forward-looking manner. For instance, decision-making process and policies will have to be updated to support nature-based solutions, which are also an important answer to climate and biodiversity crisis. One cannot isolate anymore the natural capital from the financial one. They have to go hand in hand. Financial institutions will have then to align their portfolios to targeted biodiversity footprint, just as is being done for climate. That requires well-defined steps. First of all, to define the scope of biodiversity impact, just like for climate, scope 1, 2, or 3. Mm-hmm. Measure the baseline that would act as a reference point. Select future biodiversity scenarios that will be used as benchmarks and for target setting. Measure portfolio alignment with selected scenario, and then set targets based on priorities and impacts. And here as well, let me point out that methodologies for assessing the biodiversity footprint start to emerge, like the biodiversity footprint for financial institutions, and it is already being used by some banks to align their portfolios on biodiversity footprint targets, and I consider it as being an excellent news in the financial market.
Now that you're mentioning tools, I would like to refer to some tools we've been developing, but before that, and I think you have laid the ground on what needs to be done, but do financial institutions, how are they going to look at the governance element in all of this?
Yeah, so this is indeed an excellent point, and thank you, Juan, for raising it. So to achieve the above objectives, financial institutions will have to adapt their governance. So there are three aspects I'd like to tackle here. The first one is the setup of a sustainability expert advisory group to the board and executive committee, and that body ensure that the right competencies and experience be taken into account while making strategic decisions and defining the risk appetite. This is already, by the way, being implemented by some banks like HSBC. So they are really embedding into their governance very natural environment-related expertise. The second element is the creation of a dedicated sustainability business unit whose purpose is to analyze specific risk return of new business opportunities generated by sustainability. By creating it, for instance, a bank like BBVA clearly showed that sustainability is not only about disinvesting in line with upcoming regulations, but well investing to generate new business flows that create value. The third aspect is the appointment of sustainability correspondents within the business lines, responsible for bringing sustainability within their business models, as it is indeed key that sustainability is not only owned by, I would say, a separate ESG unit or by risk, but by the business, because sustainability cannot be managed in an ivory tower. CGIAR has been an actor in biodiversity on the global stage for many years, knowing that in order for biodiversity to evolve positively around the world, natural capital assessment is key. Has CGIAR worked on that topic, and what are the results of such a work?
Yes, absolutely. We've been, as many other research organizations, supporting a lot of the carbon measurement, climate change related kind of things. But in the recent past, we've been focusing more and more on biodiversity assessments to support change in practices across governments, business, etc. And that data that is still a little bit behind that of carbon on biodiversity and agrobiodiversity, it's already becoming available. We specifically developed a toolbox that's very robust. It's been in our shop, in our labs, in hands of our scientists for a few years now, which we call the Agrobiodiversity Index. And it's basically an action-oriented tool, precisely to your point, to change behavior and through information, through data, through using our results, our evidence that can say, okay, what's a good pathway to work and in the private environment under a more sustainable manner, for example. And in that index, we look at things such as risk and resilience assessment, so companies can identify their own business decisions and how those decisions would have outcomes that are nature positive, as we discussed, and again looking at their strategies and assessing their interventions in different product lines or across supply chains, for example, or even alignment with SDGs or with specific policies coming from more local environments, from government regulations, etc. So projecting what those decisions, how they would impact and meet those SDGs, for example. So these are tools that can be used at the firm level, at the business level. That could be used at an industry, at a landscape, at a government level, and we have already the ability to shape it and integrate different parts of the toolbox in order to meet that demand. Also, it's a great tool for benchmarking, and the race for the top has always been a fantastic incentive for business growth. So as we are able to provide a benchmark of who's the best in terms of performance in the industry, that generates the incentives for others to follow, and as an industry perform a lot better following the guidelines that you referred. There are other elements, and I would like to go very quickly. We have, for example, some work that's funded by the Bill and Melinda Gates in Kenya, where we're starting to define climate adaptation credit facilities for agriculture that look at those natural assets, soils, plants, diversity, etc., and help producers and agri SMEs assess better their climate risks, and their financial sector, the first floor banks invest and lend into those SMEs with more comfort, given they are covering better their risk, and they are becoming, by changing their practices, more resilient. So there is a number of examples, a number of tools, all based on decades or research in the recent years from our organization. Okay, so Dominique, what else, or what is the trick? What's the trigger to support financial institutions to achieve those objectives? How they can effectively integrate natural capital in their risk management frameworks and their decision making?
Okay. To do that, I will consider today 4 main pillars. The first pillar is about definitions, measures, and standards. What we first need is a common understanding of what biodiversity means and encompasses, and including expertise regarding sectors which have the biggest negative impacts on biodiversity. As you mentioned, we need a set of well-articulated measures of natural capital footprint, such as the Agrobiodiversity Index you just presented. I take the opportunity for stressing how important it is for financial institutions to get involved in the design and use of such indicators. A set of commonly agreed high-level principles among financial institutions would also help reach a positive biodiversity target. For instance, these are the 6 key principles that the Financial Services Task Force, made of the largest banks, came up with in October regarding emissions. This is very inspiring.
And very recent as well.
And very recent, indeed. A global uniform taxonomy, like the EU one, is key to allow players to move away from biodiversity negative activities, but also to promote positive ones. We need here to adopt also a positive language. There is a need for consistent, standardized self-assessment methodologies for companies to run their own assessments on both natural capital impacts and dependencies at the level of upstream, on operations downstream, and across many dimensions like scope, horizon, organizational focus, business and societal values. This would ensure that they can proactively report to their clients, shareholders, financial investors, regulators and rating agencies. And we could also then separate of the wheat from the chaff, ensuring best in class, obtain recognition and market share as a key driver to green transition, as you pointed out earlier on. Then a set of accounting and reporting standards. Good news is IFRS took the lead with the ISSB standards to encompass the full value of capital, of natural capital. This is key, as you know, to ensure consistency, comparability and transparency, as well as interoperability of financial flows, while taking into account, of course, the proportionality principles for the smaller institutions. Impact-weighted accounting standards encompassing the societal value being generated along with the financial value need to be further developed as well. The second pillar is about creative, innovative finance. Innovative financial models are critical to support impactful and scientific-based sustainable developments. They need to be better suited. I think we all recognize that in terms of time horizon, pricing, type of assets being covered, including small tickets. Mm-hmm. There should be a specific well-defined category for transition equity, increased blended finance and risk transfer mechanism for de-risking purpose. The third pillar is about incentives. All players need to be incentivized towards aligned objectives. And such incentives can take many forms, such as green capital release, sustainability premium, impact-driven repartition of margins across the value chain, carbon or any other sustainability-linked market. The fourth pillar is about regulations. We cannot forget about regulations, ratings and audits. Adequate regulations for financial institutions are needed to set the scene and, for instance, to provide global relevant biodiversity, natural capital stress testing scenarios. ESG ratings need to be upgraded to include relevant features related to capital and biodiversity as to reward biodiversity while avoiding greenwashing. And finally, we need an upgrade of auditing processes and skills to run natural capital assessments in a timely and reliable manner.
I think in the last pillar, when you refer to greenwashing, in a lot of conversations I've been having, this is becoming an obsession. And through the UN Food System Summit, etc., how do we make sure all of these tools, all of these indicators are not a way or are not used as a way to get out of the big commitments and needs with minimal effort. So that's going to be absolutely critical to calibrate across the board the efforts of the industry so SDGs are met and change really happens. So in terms of organizations such as ours, with scientists, with feet on the ground in many countries, where do you see our role? What role do you see for us to promote the adoption of this culture and these new assessment tools?
Yeah, so first of all, I see definitely a role for associations like yours. Partnerships with experts like CGIAR are great value to financial institutions, as you can bring the relevant contextual knowledge and data. You can also help formulate bankable and insurable biodiversity projects and stimulate the emergence of biodiversity brokers and orchestrators. As you know, innovation might be well hidden, and it's very important to make innovation transparent and well understood to the market players while ensuring that it remains consistent with the business objectives and constraints. And you are ideally positioned to do that.
Yes, indeed, as you may know, we are at CGIAR facing a very important reform so we can get a much higher impact at scale. And one of those elements where we have probably felt short historically has been our engagement not only with the private sector but with the financial sector. And we see that we have a wealth of knowledge, of evidence, of impact pathways that we need to be useful in support of these new sustainable finance avenues. And this is the reason why we are setting up an institutionality that can connect our knowledge to, for example, financial sustainable finance streams, meaning that we may end up becoming not only data and evidence providers and publishing papers, which is something very important, but even becoming the TA providers behind a number of these emerging investment vehicles.
Yeah, and this is a great initiative. I'm very excited to see the results of this initiative. So thank you, Juan, and I would like to conclude with a few takeaways. So financial institutions must build their capacity now to analyze and manage risk linked to biodiversity loss. Policymakers and supervisors are increasingly focusing on financial risk related to the environment, and as it is undebatable that the biodiversity and natural capital risk translate into financial risk. Biodiversity helps to limit climate change, but is at the same time negatively affected by it. One cannot derive strategic path to net zero in isolation from the natural capital. It is critical that both objectives of net zero and positive biodiversity be tackled simultaneously. The strategic path to net zero should take into consideration that the deployment of alternative technologies and infrastructure needed is heavily dependent on the availability of natural resources such as raw material, land and water. To set the scene, to generate the same amount of electricity, solar technology would require more than 100 times land surface than a classical gas plant. The positive biodiversity objective would rightly put some constraints on the alternative technologies that will be proposed, and the nature itself can provide its transition solutions. There might be trade-offs to be made. By tackling climate and biodiversity together, Those will be made transparent all along the way, and we will not face the unacceptable risk of realizing at the end of the road that net zero scenarios and strategic paths failed simply because we neglected a significant part of the equation. As Winston Churchill said, now this is not the end, it's not even the beginning of the end, but it is perhaps the end of the beginning. I trust that you will all begin to embed biodiversity and natural capital in your risk management and strategic decision making with the same importance as climate, and that your contribution as financial institutions will drive a massive transition towards a nature positive and negative emissions economy.
I fully agree with that, and I can tell you, and I hope we were able to convey today that there is not a silver bullet. That, as you said, we need to address the trade-offs and understand that the solutions lie within this nexus of climate, biodiversity, and food challenges that are absolutely interconnected. So we need to adopt a system approaches if we want to bend the curve on this sixth mass extinction. That is not only about leaving for future generations a better world, but it's really about ensuring that we have the tools from biodiversity that biodiversity can provide in order to tackle not only present but future challenges. I would also like to make a pitch for more research and investment around these issues. Of course, we are coming up with a lot of evidence, pathways, etc., but there is a clear disease, an issue with underinvestment and research innovation. So we need, in order to cope with SDGs and with societal outcomes, a big boost on investment, so we can provide the data, the solutions, the technologies that are needed. So in a nutshell, we need to step up our game. We need to bend the curve on biodiversity and mitigate its impact, its risk in the economy, business, and society in general. I really hope, Dominique, that through this conversation, first I learned a lot from the industry and from you. I hope we together were able to convey the urgency of this and also the opportunity, because there's the first comers are always big winners on this, and they will be big winners for themselves as well as with huge spillovers for society. So it's a great conversation. It's great to see you, meet you, and engage in this Risk Minds conference today.
Yes, thank you very much for your involvement in this, and I'm very happy personally, and I hope that finance will meet natural sciences much more often in the future.
Or that scientists can meet
yes.
finance in the future.
Exactly, on both sides. Thank you very much.